The Federal Reserve just cut interest rates by 0.25%, and the headlines cheered. But if I told you that this seemingly small cut is actually a dangerous signal, a move designed to lie to you about the health of the economy, would you listen? Behind that positive headline, something much bigger and more critical is unfolding, and the market's behavior has just exposed the Fed's hidden agenda. The rate cut isn't just about controlling inflation. It is about the power over money, the power over the global markets, and ultimately, the power over the future of the artificial intelligence revolution. We are going to dig deeper into this interconnected system. At the very center of this massive shift, I want to talk about one company, located on one crucial island, where a single geopolitical decision could change everything for the $5 trillion run of Nvidia and the entire AI economy. In this video, we are going to expose the hidden mechanics of what the Fed is truly doing. We'll break down quantitative tightening, or QT, and why it is quietly draining money out of the system even while everybody celebrates the rate cut. Then, we'll connect all the dots. How Nvidia's astronomical run ties directly to one single factory, making it the biggest, most critical risk to the global economy. Finally, at the end, I will show you one stock that I am personally buying right now because, while everybody else is panicking over a temporary drop, the greatest opportunity always hides inside of the chaos. Stay locked in with me, because this analysis might fundamentally change how you see the market over the long term. Now, before we get into this deep dive, you know exactly what I need you to do. Like this video, subscribe to Economics X, and most importantly, talk to me in the comments. Tell me how I can make this channel better for you and our community. And let me be crystal clear, as always. Everything we provide here is 100% education, but you must always do your own research. You hear me? This is not financial advice. I need you to take the information that I lay down, compare it with the research you do, and then make the best, most informed financial decision for you. The rate cut. A signal of stress, not strength. The Fed finally cut rates by 0.25%. It sounds negligible, but this move tells a huge story about the underlying stress in the American economy. When the Fed cuts rates, it lowers the cost of borrowing for banks and consumers, which is like hitting the gas pedal on the economy, attempting to keep the money flowing. The crazy thing is that this is happening while the official inflation rate is still around 3%, which is significantly higher than the Fed's target of 2%. Their own projections keep getting pushed back, suggesting they won't hit that 2% goal until around 2028. What they are essentially saying is this: we can live with higher inflation for a while. The critical question is why. The economy is definitely showing cracks beneath the surface of a surging stock market. Consumer debt is hitting an all-time high. Unemployment is slowly creeping up, and the housing market is frozen, with fewer buyers than sellers due to high mortgage rates. This rate cut is not a sign of confidence. It is an insurance policy against a downturn. But we absolutely cannot let the positive headlines fool us. Every time the Fed cuts rates while inflation is still structurally high, it is a clear signal not of strength, but of stress in the financial system. Let's dig deep into the official release from Chairman Jerome Powell. He stated that the committee decided to lower the target range for the Fed funds rate, the rate at which banks lend money to each other in support of their goals, and in light of the shift in the balance of risk. The range was lowered by 0.25% to between 3.75% to 4%. Here is what sent the market into a temporary correction. A reporter asked Chairman Powell if they would cut rates again in December. He revealed that the 19 members of the board are not in agreement on what to do next. This division is a direct result of the cracks in the system. There is a government shutdown right now, which means the Fed is not getting reliable, real-time data. As Powell himself said, it is like a car driving in the fog. You need to slow down. They are relying on potentially faulty private data to make decisions. Combine this with rising unemployment and the fact that people are losing their SNAP benefits. Remember that in the last meeting, Powell noted there was pressure on the lower pockets of the economy. The reality is that there are more people in the lower economic brackets than in the wealthy brackets, especially in America. If the economy is supposedly strong, but there is immense stress on employment and pricing for the majority of the population, if people are losing their food benefits, then the economy is not strong. The rate cut, ironically, primarily allows the wealthy to get richer by providing cheaper capital for corporations and large investors. My goal is not to promote hate, but to help all of us understand the mechanics so we can offset this with smart trading and investing. The hidden hand, quantitative tightening. Here is the secret weapon the Fed uses that most retail investors completely miss. While the Fed cuts rates in public, it is still quietly tightening liquidity behind the scenes through something called quantitative tightening, or QT. Let me simplify QT for you. During the pandemic, the Fed was buying massive amounts of bonds, which are how the American government finances its debt. The Fed would buy these bonds, pumping cash directly into the economy, a process called quantitative easing. The Fed is an individual entity, separate from the government, a fact you can read about in the book A Creature from Jekyll Island, which details how the largest bankers like J.P. Morgan took control of the money supply. Quantitative tightening is simply the reverse. The Fed is saying, the bonds we bought are now maturing, and instead of taking that money and buying more bonds, which would put the money back in the system, we are just going to let the bonds expire and keep the cash on our balance sheet. This is called a balance sheet runoff. When the Fed takes the money from the maturing bonds and does not put it back into the system, money literally leaves the system. This means there is less liquidity, which translates to less fuel not just for stocks, but for the entire economy. Think of liquidity, the available money, as the oxygen for the American economy. The Fed controls the air, and right now they are rationing it out. They cut rates just enough to signal confidence and encourage some growth. But they pull back the liquidity through QT so inflation does not absolutely explode out of control. This is the hidden hand they are using. We knew this was coming in 3 distinct phases. First, ending QT, which they said would happen by December 1st. Second, lowering rates. And third, starting to put money back into the economy in 2026, which is when inflation is guaranteed to pick up again. The more money they print and put into the economy, the more our dollars lose value. This is why I keep telling you, buy you some gold. These little pieces of physical gold cost me about $500 each. I started buying in 2019, and I keep buying a little bit at a time. You might be thinking, I can't afford that, but you can. You have to put physical gold in a safe place, store it, and keep buying it, because there will be a time when you need it. Gold is where the value is stored. The final piece of this puzzle is the market's initial reaction. Even though the Fed is speaking in moderation, saying they need more data due to the government shutdown, the market knows exactly what they are doing. The short-term uncertainty caused the dip, but the long-term prognosis, more easy money coming in 2026, is why you must position yourself now. The chaos is the opportunity. Now let's transition to the heart of the artificial intelligence revolution and the massive hidden risk that is threatening to unravel the entire $5 trillion market surge. We are talking about Nvidia, the absolutely amazing company that has become the biggest name in the market, hands down. Nvidia was the first company to hit $4 trillion in market capitalization, and now it has officially become the first to hit the $5 trillion mark. This is not just a chip company anymore. It is the fundamental, technological foundation for the entire AI revolution. I believe that by sometime next year, it will likely hit the $6 trillion mark, with a stock price pushing $300 to $325 a share. Nvidia now makes up a massive 7% of the entire S&P 500 index. This means that if Nvidia sneezes, the entire market catches a cold. I want you to understand just how systemically strong this one company is. But here is the absolute truth, the Wizard of Oz moment that most people completely miss. If you ask the average investor about Nvidia, they will tell you Nvidia makes chips. That is technically false. Nvidia does not make the chips, they only design them. They own the valuable intellectual property behind the chips, which is what gives them their incredible profit margins. It is like the scene in The Wizard of Oz when Dorothy and her companions finally reach the supposed all-powerful wizard, only to realize he is a phony pulling levers behind a curtain. I am not saying Nvidia is a phony, far from it, but they are not the most powerful company in the world right now. The most powerful company in the world is the one that actually manufactures the chips, TSMC, or Taiwan Semiconductor. Taiwan Semiconductor is the crucial contract manufacturer. They produce between 80 to 90% of the world's most advanced chips. These are the exact same chips used by Nvidia, Apple, AMD, and virtually every other supercomputer on the planet. TSMC creates the highly advanced M-Series, A-Series, A100, H100, H200, and B200 chips that the entire AI revolution is built upon. Here is where the situation becomes incredibly intense and dangerous. The geopolitical tinderbox China has been rapidly, visibly expanding its military operations. They have been building numerous naval boats and landing ferries, 17 of them, designed to hold tanks, soldiers, and even small aircraft, with another 13 ships currently in development, all scheduled to be finished by 2026. This aggressive, large-scale naval buildup is directly aimed at Taiwan. We have already seen China surround Taiwan with boats in what they called practice drills. When have you ever seen someone point a gun at someone else and call it practice? Taiwan is only a short hop, skip, and a jump from the Chinese mainland, and the island itself is small compared to China's massive military. Now, while TSMC is building a manufacturing plant here in America, they have publicly stated that it is almost impossible for them to uplift their entire, complex, highly specialized manufacturing base and move it. This is why the world, and specifically the United States, is forced to protect Taiwan from any aggression by China. TSMC is the indispensable foundation of the entire AI and advanced technology revolution. One small island, one critical company, one single military spark, and a $5 trillion market value, the cornerstone of the entire American economy, could evaporate instantly. We must protect this company at all costs, because if this entire technological revolution is built on top of this one entity doing 80 to 90% of all the manufacturing, that is a severe single point of failure. I am not saying that everything is about to go crazy right now, but we absolutely must brace ourselves for the possibility. Concentration risk in the market. Let's zoom out to the broader market and see how this one vulnerability ripples across your portfolio. The so-called Magnificent Seven companies, Nvidia, Apple, Microsoft, Amazon, Meta, Tesla, and Google, now make up a staggering 35% of the entire S&P 500. Out of those seven, only one company is not reliant on the AI supply chain that runs through Nvidia and TSMC, and that is Apple. Apple understood the concept of a single point of failure early on. They have been aggressively working to become vertically integrated, weaning themselves off external reliance on companies like Broadcom and Qualcomm to design their own internal chips, the M-series and A-series. Apple didn't want to be dependent on others for integral parts of their business. So when people say the market is up, what they really mean is that a few select stocks are up, and now those very few stocks have become solely dependent on one company on one island. That is incredibly dangerous. It is called concentration risk. If TSMC stumbles, the entire market shakes. Think about the domino effect. Nvidia drives AI, Microsoft drives the cloud, Apple drives hardware, and Meta drives user attention. They are the pillars of the market. Remember that every bull run has a clear theme. The theme of the bull run we are in right now is artificial intelligence. And now, all the companies driving this theme are connected by the same supply chain, TSMC, the same liquidity, the Fed's QT, and the same Fed policy, rate cuts. We have looped the system back together. Unlike the dot-com bubble of the early 2000s, these companies have the financials, the massive revenue, and the true earnings. But if any one of these pillars weakens, especially if the manufacturing base for their entire product is compromised, it will create a tremor that could rip through your entire American portfolio. My goal here is not to frighten you. It is to equip you with the knowledge to pay attention and position yourself wisely. Now that we understand the hidden risks and the Fed's subtle liquidity drain, let's talk about seizing the opportunity that chaos always provides. I want to talk about one company that I like, which gave us an incredible discount the other day, and I don't think enough people are going to take advantage of it. This company delivered an absolutely strong earnings call, and yet the stock price fell. In that brief moment of market panic, there is always an edge. Meta reported a very strong quarter. Revenue was up 22% year over year. Its ad impressions were up 20%. They generated $28 billion in free cash flow, and they raised their guidance for the future. However, here is what caused the immediate panic. They had to account for a massive one-time tax bill of $15.9 billion, which absolutely hammered their earnings per share, or EPS. The stock dropped by nearly $70, an approximately 78% fall. I looked at that and thought, this is fantastic. If Meta had not been forced to pay that tax bill, their EPS would have been around $7.25, which would have sent the stock soaring by another $70 a share. Because the stock fell by $70 due to a one-time, non-recurring event, that is a clear opportunity. Their user base is expanding, their fundamentals are strong, And this entire dip is nothing but a temporary discount, a moment of weakness that smart money buys into. Now, I know what many of you are thinking. Trap, can't nobody afford that $700 stock? I have something for you, because I have been changing my own thinking on this. We need to get past the idea that you have to buy a whole share. Mark Zuckerberg is truly growing this company at a rapid pace, and I have conviction that the underlying business is sound. My own Robinhood account is up 61% year to date. I've been playing around with it, doing some small trades, and it's up over $6,000 on an initial small deposit. I want to show you that there is no excuse for not participating in the market. If you wanted to buy 1/10 of a share of Meta, it would cost you approximately $70. If you wanted to buy 1/5 of a share, it would cost you around $35. Start where you can. Do what you can. Get in. I am personally going to buy 1/4% of a share right now. It will cost me around $175.85. My goal is to show you that we can play this game and we can win this game by starting where we can. I will continue to do small trades and buy and hold positions in this account, just to show you in real time that building a portfolio is possible for everyone. The message is clear. Fear sells, but conviction is what builds wealth. When I see a company like Meta that fundamentally knocked it out of the park but was hit by a one-time charge, I think bigger picture. The crossroads of wealth. The system is currently at a crucial crossroads. On one side, the Fed is cutting rates but draining liquidity through quantitative tightening. On the other side, the AI boom is soaring, creating immense momentum. This convergence is the calm before the next great rotation. It is the shift from investing based purely on hype to investing based on value and discipline. We understand that a massive wealth transfer is coming between now and 2035, the biggest wealth transfer of all time. The mission of this channel is to position us, the trappers, the family, to be the next generation of wealth builders who benefit from that transfer. Before you chase the next AI breakout or the next surging stock, you must ask yourself this: do you own companies that can actually survive a tightening cycle, or are you just riding momentum that will eventually fade? In this new era, discipline will beat hype every single time. I want you to be excited about the opportunities, but I want you to be disciplined in your execution. We do not need to time the market perfectly. We just need to understand where it is heading and be one step ahead of the crowd.